My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
3, 2.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Huge day. I get that. How do you explain it? I think it's about two numbers. Here are the numbers. 1.15 and 1.4. Yep, I'm talking about the plummeting yield on the benchmark 10-year Treasury, where you only get 1.15% return. How ridiculous is that? And 1.4%. And that's the apparent rate of lethality for the dreaded coronavirus. At least it's what we think it is. While bond yields have kept falling, signaling real fears about where this economy's headed, and I share this, that 1.4% lethality number is much better, of course, than 2% number we've been worried about with this outbreak, which, along with the cessation in the mad buying of treasuries this very afternoon, is a major reason why the market was able to rebound today. Dow skyrocketing 1,294 points. You know, that was the biggest one-day point gain ever. The S&P surging 4.6%, and the NASDAQ pole vaulting 4.49%. Okay, I don't want to be simplistic here. But this market's become ridiculously volatile because it's controlled by fear. That's the physical fear of getting sick, the fear of a slowdown in commerce as people become reluctant to go outside, and the impact of that fear, which is causing investors to hide their money in safe haven treasuries, like safe haven treasuries, which are giving you almost no yield. And that's driving their prices up and their yields down. Now, we've seen the most minute changes in treasury yields produce wild swings in stocks these days. We literally had an overnight bull market. The futures were down about 40 ticks when I went to bed. They were up 60 ticks when I woke up at 3 a.m. That's kind of insane. And it tells you about how thin the futures are. It also says that the market is unhealthy. And by the way, today's rally is unhealthy. I don't like to see these kinds of rallies. I don't like to see the big declines quickly. I don't like to see the big increases like this. But it's the actual events driving us in either direction we have to talk about. See, we were down first on coronavirus deaths and then jumped thanks to talk of an emergency Fed meeting that never actually materialized. What do you do in the times of extreme volatility like this? Do you just sit tight? Well, you know I'm in favor of that always, but how about taking advantage of it? I think you need to show some gumption and buy stocks when they come down to levels where you find them attractive, as we did on Friday and this morning, and then sell them when they bounce to levels that are no longer enticing. The futures are distorting everything here. And while that makes it hard to get your bearings, it can also give you some great entry and exit points. At the end of the day, you have to believe in yourself, although you should remain willing to course correct when you get it wrong. That belief is your strength in times like this. That's in my head today. You know why? It's because of the interactions I have with the legendary Jack Welch, the man who took GE from a $20 billion company to a $400 billion company with the power of conviction. And he passed away this weekend. Jack always loved that I believed in my views. When I was kicked off the old Squawk Box rotation back in 1998 for being too rough around the edges, he sent me a fax saying I was the most entertaining guy he'd ever seen on CNBC, and he applauded me. I showed the facts to the old management team, and much to their chagrin, I got myself back in the rotation. More importantly, you need some facts, especially facts about this outbreak, because the outbreak is all about fear, and as I told you, the fear then goes right down into a rush of stay-at-home commerce. See, I think the facts and the concomitant reversal of rates from the ridiculous lows that they allowed, that's what allowed the market to roar today. The facts and then the switch of the yields. See, there are very few people who have any real, let's say, gravitas when it comes to this coronavirus. I mean, you hear these people come on TV and they say things, but there's only one guy that we all revere. Only one. His name is Dr. Tony Fauci. And he did breakthrough work with AIDS and is part of the government's apparatus that was allegedly been silenced by Vice President Pence. But if Fauci's being silenced, it's odd to see his byline in the most distinguished publication in healthcare this weekend, in healthcare forever, but this weekend, his byline. And that's the New England Journal of Medicine. In the single best article I have read on this epidemic, and it's not it's not to sell papers, it's titled COVID-19, Navigating the Uncharted. Fauci notes something huge. There's a study of 1,099 laboratory-confirmed patients, and they showed a mortality rate of 1.4%, which is what we keep hearing about, 1.4, 1.4, 1.4. Why is it so important? As Fauci explains, if one assumes that the number of asymptomatic or minimally symptomatic cases is several times as high as reported cases, the case fatality may be considerably less than 1%. In other words, if the denominator is much bigger, then maybe we're not in as much trouble as we thought. And here's the statement that I think gives credence to this rally. Quote, this suggests that the overall clinical consequences of COVID-19 may ultimately be more akin to those of severe seasonal influenza. Boom. We've been hearing that it might have a 2% fatality rate. 1.4% is much lower than that. And it's even possible that after reading this article, you have to believe that 1.4% is way too high. Fauci goes on to note that the real number could be as low as 0.1%, or like the 1968 flu season that killed 32,800, or the 1957 flu season that killed the equivalent of 107,000 in today's terms. The death rates for pandemics tend to be much higher overseas than they are here. Our healthcare system isn't perfect, but it's a lot better than China's. I felt somewhat reassured by this article that is available online and makes you put things in perspective for the first time since this began. Does it mean all this panic was much ado about nothing? Absolutely not. The coronavirus is still a serious problem. The disease is so easily transmitted that you can see many people deciding to stay home and wait it out if they can afford it. And that's why I keep recommending the stay-at-home economy stocks like a Zoom Video, Adobe. We know that China's been practically shut down for the better part of a month. And anyone who works at a business that shuts down because of the virus is going to take a hit. That's why I think it's a very good time to reevaluate your portfolio, sell the stocks into strength that we have that I think are going to continue to go down in a corona-induced slowdown. For example, even with a lower death rate, you should stay the heck away from travel and leisure stocks because no one wants to catch the disease. Today, I saw some research recommending Cheesecake Factory, compliment Friday's recommendation of Darden, which is parent of Olive Garden. I say, no. Don't buy a restaurant stock going into a possible pandemic. People are going to stay home. The delivery business is much more lucrative. If there's any way to cancel a cruise, I bet you it's going to get canceled after that Diamond Princess fiasco. My guess, 18 months before the cruise lines can count on this on the reservation list being real. That's how long it took for people to get over Chipotle's most recent food scare. Historically, 18 months had been the pattern. I see the same thing happen in the Carnival. Now, since we're talking about financial markets, I know that there will be an endless drumbeat of experts telling us that the Fed can solve the slowdown with lower interest rates. This is a public health problem, though. You can't cure the coronavirus with monetary policy. Think about who benefits from lower rates. I'm currently in the process of getting a mortgage. I have a great credit rating, yet the mortgage is half a point higher than what I was paying when the benchmark 10-year Treasury was double where it is now. They're not lowering those rates. I'm not opposed to the Fed adding liquidity, but it doesn't do much to fix a slowdown that's caused by a public health crisis. No amount of rate cuts will make people go outside if they're afraid of getting sick. Of course, there are things the government can do to make things easier. I am proposing right here, right now, that if I were president, I would offer $100 million to whoever comes up with a decent treatment for the disease or workable vaccine. Yes, a scientist, a company, I don't care, $100 million tax-free. If I were Treasury Secretary, I'd make sure that small businesses get credit lines so they can stay in business even if they have to close down temporarily, and therefore they can still pay their employees. That said, there are other reasons we rallied. Maybe you think it's the resurgent Joe Biden, who the Democratic establishment now circled the wagons around in order to fend off Bernie Sanders. Status quo Joe was much better than the market for the market than Bernie. Maybe you believe there'll be an emergency Fed meeting. Maybe you think there'll be a lot of central bank intervention. And maybe you think there's going to be Chinese stimulus tonight or every night. But the bottom line, I think stocks soared today because Wall Street realized that the coronavirus might be the equivalent of a severe flu season. Not great, but it's not going to cause the endless economic devastation that you'd expect from a virus with a 2% fatality rate or a 1.4%. I'll take it. And I bet, by the way, that the 10-year goes back to 1.4% too. Hey, why don't we go to Phyllis in New York? Phyllis.
Thank you so much for taking my call, Jim. I had called before.
Yes.
And you gave a great big booyah to my largest holding, which is Wendy's. And today I'm very excited because today was the breakthrough on their breakfast menu, which came out. And I thought it would be a great game changer. I myself will deposit, buy stock as I
Phyllis,
get extra cash.
Yes, Phyllis, I'll tell you, the stock fell too much. The breakfast is apparently all the good readings. I have great readings of Wendy's, constantly great readings. Breakfast is looking good, so I think we're in good shape. How about Jack in Ohio? Jack.
Hey, thanks for taking my call, Jimmy.
Of course.
Hey, it's bouncing off its 52-week low, but I know the competition is getting tight in this sector from watching your show, UPS.
I like UPS, 4.3% yield. It's going to be a terrific stay-at-home situation, which I think we're still going to have to, even though I know that we have, I think that we're making some headway against the virus. And it's run by David Abney. I think he does a very, very good job. I like him. All right, this volatility is unheard of, people. Use it to reevaluate your portfolio and to use some gumption and get your prices to buy or, of course, into strength. Get rid of the ones that aren't going to work. Mad Money tonight. Stocks bouncing back after the worst week since the financial crisis. It's time to start hunting for buys as stocks remain off their highs. Hey, I'm going to sit down with the CEO of Beyond Meat to see if one of the hottest stocks in this market is still worth considering. Then the CEO of Twitter could be looking for a new job soon as Elliott Management presses for big changes at the company. What could it mean for the stock going forward, which is what you care about? And in a world where people are more and more likely to be working remotely, companies need a well-developed digital backbone. I'm eyeing one company that could help. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.